All right, let's dive right in. We're going to talk about a single number, just one, that is literally the foundation for almost every financial valuation you will ever see. It's called the risk-free rate, and by the end of this, you're going to see why finding it is as much an art as it is a science.
You know, it all boils down to this one simple question. If you wanted to invest your money with an absolute, ironclad 100% guarantee of getting it back, plus some return, what return could you actually expect? Just think about that for a second.
And this quote from finance professor Aswath Damodaran just nails it. The answer to that question is the risk-free rate. It sounds so simple, right? But like he says, it's something we have to grapple with. It's not just a number you can look up on Google.
So, here's our game plan. First, we'll see why this rate is the absolute starting point for any valuation. Then, we're going to shatter the whole risk-free illusion. After that, we're going on a global hunt for the real rate. We'll learn how to decode default risk, and we'll wrap it all up with the one big takeaway you need to remember.
Okay, first up, valuation starting point. Seriously, think of the risk-free rate as the concrete foundation of a massive skyscraper. If that foundation is cracked, the entire building on top of it is in trouble.
Now, don't let the fancy name scare you, but this is the Capital Asset Pricing Model, or CAPM, and it shows this perfectly. Just look at the equation. The very first thing you need is the risk-free rate. It's the baseline. Every other bit of risk you take on, in a stock, a project, whatever, is measured as a premium, an extra return you demand on top of that base rate.
But before we go any further, we have to lay down two non-negotiable ground rules. It's called the consistency principle. Rule 1. If your financial projections include inflation, then your risk-free rate has to include it too, apples to apples. Rule 2. If your cash flows are in euros, your risk-free rate better be a euro rate. If they're in dollars, you need a dollar rate. You absolutely cannot mix and match. And that brings us to where things get really interesting. The risk-free illusion. You know, most people's first instinct is, oh, that's easy, just use a government bond rate. Well, as we're about to see, it's not quite that simple.
Here's what's so important to get. For an asset to be truly, genuinely 100% risk-free, it has to meet two incredibly strict conditions. First, the issuer, which is usually a government, has to have zero, not even a hint of default risk. Second, there can't be any reinvestment risk. That just means if you're valuing a company over a 10-year period, you need a 10-year risk-free rate, not a short-term rate you have to keep rolling over.
Okay, now for the fun part, the hunt for the rate. We're going to take these rules and actually try to find the risk-free rate in 3 different currencies, going from easy to medium to hard.
Let's kick things off with the easy case, the US dollar. The go-to move here is to just use the 10-year US Treasury bond rate. But when we do that, we're making a massive assumption, right? We're assuming the US government has absolutely no default risk. For now, let's just go with that. So, you might be asking, wait, why the 10-year? Why not a 30-year bond if we're valuing something for the long term? And that is a fantastic question. It shows how practical finance has to be. We picked the 10-year because it's way easier to find all the other data we need, like corporate default spreads for a matching 10-year period. It's a smart, practical compromise.
Okay, time to level up the difficulty, the euro. Now here's the puzzle. You've got one single currency, the euro, but you have a whole bunch of different governments, Germany, Spain, Greece, all issuing bonds in that exact same currency.
And would you look at this? They all have different interest rates. These are all 10-year bonds, all paid back in euros. The only possible reason for the different rates is that the market thinks some governments are riskier than others. The market is demanding a higher rate from Greece than from Germany to borrow the exact same currency.
So which one is the risk-free one? Well, the answer is pretty logical. You use the rate on the German bond. And it's not because it's German, it's because it's the lowest rate available. That low rate tells you the market sees it as having the least default risk, which gets us as close as we can to a truly risk-free rate in euros.
All right, now for the final boss, the hard case. We're going to find the risk-free rate in Brazilian reais. For an emerging market currency, we absolutely cannot just grab the government bond rate and call it a day. Everybody knows that rate has a real risk of default baked right into it. So we've got to perform a little surgery.
Okay, let's do this. We start with the stated interest rate on a 10-year Brazilian government bond. Let's say that's 9%. But we know that number is bloated. It's not pure.
Our job is to carve out, to subtract, the piece of that rate that's just there to compensate investors for Brazil's country-specific risk.
And using market data, we can estimate the country default spread is about 1.75%. So we do this simple
And we're left with 7.25%. That right there is our best estimate of a true risk-free rate in Brazilian reais. We've surgically removed the default risk. Which of course leads to the big question, where on earth did that 1.75% number come from? How do you actually figure that out? Well, let's open up the analyst's toolkit.
There are basically three main tools analysts use. First, if a country like Brazil also issues bonds in US dollars, you can just compare the rate on that bond to a US Treasury bond. The difference between them, that's your spread. Second, you can look at something called the credit default swap market. A CDS is basically an insurance policy against a country defaulting, and the price of that insurance is a direct measure of its perceived risk. And third, if those don't work, you can fall back on the country's credit rating from an agency like Moody's and use a lookup table to find a typical spread for that rating. And that brings us to the end, to our final takeaway. This is really the most important thing to remember from all of this.
So the most important takeaway here isn't a number. It's a principle. It's a way of thinking. A risk-free rate isn't some fact you just look up in a book. It's an estimate that you have to carefully build and be ready to defend. And that leaves us with one last question to chew on. If it takes this much thought and this much work just to define the starting line, the rate on an investment with supposedly no risk, what does that tell you about how incredibly difficult it is to properly measure and price actual risk out there in the real world? Something to think about.